The headlines are terrifying. Markets are crashing. Companies are laying off thousands of workers. Experts warn that the economy could get even worse. Everywhere you look, people are panicking. Your friends stop talking about investing. Instead, they start asking one question. Should we sell everything? You open your investment app. Your portfolio is down 25%. Almost every stock is red. It feels like years of progress disappeared overnight. Your heart tells you to sell before things get even worse. But then you remember something. Every major recession in history eventually ended. Every market crash eventually recovered. The people who became wealthy weren't the ones who sold in fear. They were the ones who stayed patient. So instead of selling, you make a different decision. You keep investing. The first month feels painful. You buy shares that immediately fall even further. You wonder if you made a huge mistake. Your coworkers laugh. You're still buying? Didn't you see today's news? You simply smile. Because you're no longer investing based on emotions. You're investing based on time. Months pass. The recession gets worse. More businesses struggle. More scary headlines appear. The market drops again. This time your portfolio falls even lower. For a moment, doubt returns. Maybe everyone else was right. Maybe you should have waited. But then you remember something Warren Buffett once taught investors. Be fearful when others are greedy. Be greedy when others are fearful. Right now, fear is everywhere. So you keep buying. Every paycheck. Every month. Without trying to predict the bottom. Your friends decide they'll wait until things look safe again. Weeks become months. Months become over a year. They're still waiting. Meanwhile, every investment you make buys more shares than before. The lower prices stop looking scary. They start looking like discounts. Instead of focusing on today's price, you focus on what those companies could be worth 10 or 20 years from now. Your mindset completely changes. Eventually, the news starts sounding a little less negative. Inflation begins slowing. Businesses slowly recover. People become optimistic again. The market stops falling. Then, something unexpected happens. It starts rising. Slowly at first. Then, faster. Many investors rush back into the market. But they're buying after prices have already increased. You realize something. You were buying those exact same companies when nobody wanted them. A few years later, your portfolio reaches a brand new all-time high. Not because you perfectly timed the market, not because you picked magical stocks, but because you refused to stop investing. Every share you bought during the recession is now worth far more than when you purchased it. Those scary months became the foundation of your future wealth. Looking back, you realize recessions test something much more important than investing knowledge. They test discipline. Anyone can invest when markets are hitting new highs. Anyone can feel confident when everyone is making money. The real challenge comes when fear takes over. When every headline tells you to quit. When everyone around you believes investing is a mistake. That's when long-term investors are truly made. Years later, someone asks how you built your wealth. They expect you to reveal a secret strategy, a hidden stock, a perfect market prediction. Instead, you give them a surprisingly simple answer. I never stopped investing. They look disappointed because they wanted something more exciting. But the truth usually is, wealth isn't built by avoiding recessions. It's built by continuing through them. The market will crash again someday. Another recession will eventually arrive. Fear will once again dominate the news. And when that day comes, you'll remember this lesson. Because while others see a reason to run, you'll see another opportunity to keep building your future. Sometimes the greatest investment decision is simply refusing to quit.